Thank you all for coming in. This is all a team effort of everyone, of all our constituents here at Eyecelerator to make this meeting what it's been, and we are very grateful to the Academy for their leadership in starting out this meeting. Let's just give a little overview here of Eyecelerator, because there's so many innovation meetings now, which is exciting, and we love it. We love to see more and more of these meetings everywhere around the world. We really were the first society-sponsored meeting, really through the vision of AAO, and initially Ascaris to come together and form Eyecelerator. And this has grown into by far the largest meeting in the world, kind of the Super Bowl of innovation meetings as we go through the whole year cycle of them. We're a little bit unique in that we have a unique scale. We're the largest meeting by far, and we have a very wide scope that we're trying to engage with all of eye care in all parts of the eye. So we're not a retina meeting, we're not an anterior segment meeting. We're really covering all of the eye care and trying to do that in a continuous fashion by having multiple meetings per year. And there's no question why we're here. It's a business meeting, and it's really about advancing innovation so we can improve quality of care. We want to get innovations that not only might be financially successful, but actually get to the marketplace and are adopted and become part of the standard of care. We have two meetings. Stephen mentioned our now formal partnership with ARVO, which is very exciting, and that'll be May 1st in Denver. And then, of course, we have our Academy meeting in the fall. And we are looking to try to get even bigger in the future, and our goal is to be continuously interactive with all of you throughout the year in order to keep the cycle of innovation going. We try to take companies through the whole cycle, from a DWI, doctor with an idea, who might be in our winning pitch challenge, all the way up to a successful Fortune 500 company that's producing eye care products all around the world. We do this through WPC, through our company showcases. We'll do deep dives on companies that have achieved some level of success, but maybe still going up the mountain. And then we have a new thing we started last year, which is the Eyecelerator Innovator Award, which is really for a company that's a larger, more established company that's been able to create a product, ideally in a new market, and bring that to be a global commercial success to really change the standard of care. Our first awardee last year was Regeneron, obviously in the retina space. And this year we're very honored to have the Glaukos team here for their incredible work in developing the MIGS market and making big steps forward, both in glaucoma and now moving into other fields like anterior segment corneal cross-linking. At Eyecelerator, we use this pyramid, the sort of self-actualization period. And the idea of this is that there's innovation kind of moves up a spectrum and starts out at the bottom where there's a lot of exciting innovations. But it really needs to move up to get to the very top of the pyramid for an innovation to truly have impact. And there can be a lot of excitement here in the middle when we have positive clinical trials or big financings, and there even are financial exits in the middle of the pyramid. But those are only financial transactions unless we can make the product successful in the marketplace. And that's what our goal is here, is to get those technologies and companies moving up to the very, very top of the pyramid. And what's really been fun over the last 5 years of Eyecelerator, we've seen companies move all the way to the top with incredible products throughout all different parts of the eye, and most of you are familiar with all these companies and products. And there's more moving up. So there are recent FDA approvals of very exciting first-in-kind type products, and they're approved but maybe not yet launched, and that's what we're going to be watching for next, is what's going to happen. Can they successfully launch and sustainably grow in the marketplace? And it's very exciting now because two of these, Epioxa and SID101, those have PDUFA dates that are literally in the next few days. So there'll be a lot of excitement about what happens with those. One thing we really like to focus on at Eyecelerator are disruptive innovations in white space markets. And to us, white space markets are markets that no one's been in yet, that are speculative, that could be giant markets, but they're not really analyzable. And we have in ophthalmology a lot of incremental innovations that are going into existing markets, of which, say, better IOLs would be a classic example of that. And those are very important innovations. They're often best done by large companies. But what we try to do here is find the smaller companies that are doing disruptive technologies that are going into brand new markets, unexplored territory. And we know there's a lot of risks, like Shackleton's expedition. Some of these companies don't come back, but the ones that are successful generally create a lot more value than with incremental innovations. And we've seen white spaces before get very well developed, laser vision correction, anti-VEGF therapy, MIGS, with what Glaukos has done. And now we're starting to look forward to the new white spaces. What else is out there in myopia, presbyopia? Here I am in front of you as supposed as an innovator. I'm wearing progressive spectacles because I'm a plano presbyope. There's no good solution for treating presbyopia. And in this meeting, you're going to get a twofer. We're going to look at two very exciting areas, robotics and oculomics, that we see as white space markets. Exciting, but guess what? Nobody's really been in them yet to prove them out. We're very honored to have, in robotics, it's really being created by surgeons who are figuring out how to make robots that are going to be able to do, hopefully, surgery better than we can. It's amazing that we have Fred Moll, who truly is the founder of medical robotics, founder of Intuitive Surgical. He's willing to come to usually a flyover destination for people in the Bay Area, Orlando, to come and speak with us today and be in a panel. It's just fantastic. Fred, thank you for being here. And we've got some of the leading companies that are now trying to prove out this white space market of robotics. And another area is oculomics, which I would challenge everyone, what's your definition of oculomics? No one even knows yet because it's a white space market. But basically the idea of trying to get through imaging and other data out of the eye to be able to make diagnoses not only in the eye, but systemically. This is not a new idea. I was trained as a medical student on a direct ophthalmoscope where we were, as primary care people, supposed to look in through a small pupil and tell people about hypertension, diabetes, high intracerebral pressure. But it was so primitive, and we knew no one could actually see anything through a small pupil. So now we're trying to digitize this and get better types of imaging so we can pull out a lot more data, run it through AI, and you're going to hear an amazing panel, which I can't understand what they're talking about later on, about this brand new white space market. So we couldn't be more excited about what is happening out there all across innovation. And now my colleague, our retina program director, Alan, will bring you through the agenda and tell you a little more about our meeting. Thank you.
Welcome everyone to the Paris of Florida. And this is our community. Strategics and startups, academicians and clinicians, finance, legal, regulatory, and media. 40 presenting companies curated for you today, 93 speakers. Thank you all for being here. And the program, the curated program, can be in your hand, at your fingertips. You can look at this QR code. And I want to give a ESPN game day overview in 4 quarters of our program today. The first thing is notice that there are 5 break opportunities. It's very clear to us that innovation requires interaction and mingling. In a big meeting, sometimes that's challenging. We prioritize breaks. There's a morning break, there's a lunch break, there's an afternoon break, and there's a reception. And in the first session, we have an incisive dive into the commercial markets, investment opportunities, led by some very experienced speakers. Then we have the privilege of a robotic session. Gil mentioned Fred Moll's here, and learning from Fred and other luminaries whether robotic surgery and other domains of medicine can inform whether or not we're going to have robotic cataract or retinal surgery. By the way, that's already happened. We'll take a morning break, sponsored by Ocular Therapeutics, and we'll move into oculomics, AI-powered oculomics, which is high-quality data, reliable data, not only from retinal and OCT imaging, but from other data sources, traditional omics, like genomics, proteomics, personalized data from your watch, your heart rate, your sleep quality, your continuous glucose levels. Other sources, less traditional sources of data like environmental or social determinants of care and health. And we in ophthalmology are uniquely positioned not only to use that data with AI to innovate for disease management, but also to understand how the body heals and recovers to wellness and health. And so oculomics with AI is data powered by different data powered by AI that opens up new areas for innovation, not only in disease management, but personalized wellness, med tech devices, AI-related health services. I think it's going to be very interesting. It's a master class of people. We'll move to strategy. Gil said this is a business meeting, and nothing happens without strategy. You'll see some familiar C-suite and business development people in that panel. And then the always popular Shark Tank winning pitch challenge before lunch. Lunch will start at 12:30. Then we'll kick off the second half, the third quarter, in 3 rooms with anterior segment presenting companies, drug delivery companies, and retina companies. You can move between the rooms. It's the best of the best. We had to reject many submissions. Then we'll have a networking break at 2:45, and then the fourth quarter are innovator awards, presenting company awards, and then a special session on leadership, and you'll see some very familiar faces talking about leadership in ophthalmology and innovation. Finally, our reception sponsored by iBio will be a great time to gather and celebrate. So here's the QR code for details on the day. Go to the next slide. Can you move over? It's a real pleasure to do this with Gil. Gil was a retina specialist for about a minute, and then he moved over to the business. I still don't really understand the story, but it's really fun to do this with him. No money, no mission, clearly, Gil. It's a business meeting. You said that. Next slide. Our program committee is just outstanding. Co-chairs Bob Avery, good friend, Rajesh Rajpal, Kuldev Singh. Kuldev is really a AI human Rolodex. I mean, he knows everybody. You need to know something, he can connect you. Steve McLeod, I think for this innovation meeting, among all the others, gives this one a unique perspective as CEO of the AAO from a 40,000-foot view, not only of ophthalmology, but across medicine. Thank you, Stephen. And then our stellar, outstanding, rising superstar program committee members, my friend Leila Vazovich, Julie Schallhorn, and Charlie Wyckoff. Good friends, great people to work with. Of course, thanks to our Interwest partners and all of our AAO team, in particular, Michelle Stockton and Deb Rosekrantz, who do this for several months before each meeting, twice a year. So Gil, they have to tolerate us for probably more than half the year. I feel sorry for them, but thank you so much. Here's the program. Here are founding sponsors, AbbVie and Alcon, thank you. Our platinum sponsors, Astellas, Genentech, Merck, iBio, Ocular Therapeutics, Star Surgical. Gold sponsors, 4DMT, Polyactiva, Glaukos, Regeneron, thank you very much. And all of our bronze sponsors, all of you who make up the mix of the startup companies and innovation that people come to this meeting for. Thank you so much. Our morning break sponsored by Ocular Therapeutics and reception by Merck iBio. Thank you. And I think we go over to the first session. And so I'll bring up Raj and, no, Gil? Okay. Come on up. Gil and Ramin.
Great. Well, our next panel is going to be a financial discussion. Why don't we have everyone from the panel come up? We're going to have a fast-moving format here with 2 co-moderators, myself and Ramin Valian is coming up on the other side, and we'll start out with some mini keynote presentations and then a pretty interesting interactive panel. So why don't we have everyone come up and be seated, and we'll have Ramin on the far side, and you guys in the middle. I'll come and take this first seat, and then I'll hand it over to Ramin to kick us off.
Well, I think it's always a compliment to be called Raj Ball, so thank you for that compliment. First of all, thanks for this session, and really want to really reflect about the session. If I think about Eyecelerator, this is one of the most important sessions, right? Because we talk about innovation quite a bit at this meeting. I think as Gil laid it out, we have a lot of funding companies, a lot of entrepreneurs in this audience. But really it starts from here with this panel, right? When you think of this panel, this is where all the money is. They promised me at the end of this session, they'll be actually standing out here with their checkbooks open, so if any ideas, come up to this panel. But before we get started, let's go around with a quick round of introductions. I'll start with you.
Thank you. Hello, everyone. Good morning. My name is Roger Zhang. I'm a VP at Samsara BioCapital. We invest in new therapeutics in the ocular space.
James Murray, co-founder and managing member of ExSight Ventures. We invest across early stage ophthalmology, very broadly defined. Good to see everyone.
Hi, I'm Garrett Hamontree. I'm a partner at Visionary Ventures. We are an ophthalmology-focused venture capital fund, investing across all stages from early stage to late stage and commercial.
Are we passing the mic? Kristen Ingenito, I'm the CEO of MarketScope. I actually do not invest specifically, sorry. But we do a lot of advice and market analysis for ophthalmology specifically.
Neha Begwani, Managing Director at Morgan Stanley, part of our healthcare practice with a focus on medtech. I too do not invest in companies, but I do help connect you all with people who can provide those checks.
Well, perfect. Look, and one of the things we have to do today, obviously, Christine obviously doesn't invest in companies, but we always have to think about what's happening in the market from a market dynamic standpoint, but also what the future looks like from our market. And you've seen Christine present in the past, so we'll start with Christine with a quick market overview.
Thanks. Yeah, I appreciate this. Nobody wants to stare at the same slide all morning. So as I said, we are analyzing the ophthalmic market specifically. So with everything going on in the market, we know that there is a lot of there we go, I'll use this. A lot of noise, a lot of volatility going in the market. Typically, this is not something that markets like. So my job here is today to help you guys sort through the noise, to figure out what is actually going to be coming down the road in the next 5 years within ophthalmology. But truly, I do believe that innovation is sparked at points of friction. So I see all of the challenges that we may face coming as points where we might see some real growth and innovation in our market. Eyecare is a very resilient market, so I want to focus on the knowns and anchor there. We're evaluating the ophthalmic market at $48.7 billion in 2024. These are manufacturer-level revenues, and this does represent some growth from last year, and also we are predicting about 4.5% combined annual growth rate over the next 5 years, so through 2029. Our fastest growing segment continues to be the glaucoma surgical device space, and we're also seeing a lot of growth in IOLs. Retina pharmaceuticals continues to be our slowest growing market, but keep in mind this is by far the largest individual segment within ophthalmology, so that slow growth is coming from a very large base. PowerPoint is challenging in the morning. So the other known I want to anchor in is that our total addressable market is steady. This is going to stay consistent over the next 5 years, if not growing in several spaces. And this is across all disease states. So we're seeing that the demand isn't going anywhere. We have steady revenues. And if we look at the individual kind of segments, if we're looking at pharmaceuticals, if we're looking at implants, if we're looking at consumables, all of these different individual segments are still seeing growth. So we're not seeing any one market kind of really change the market as a whole. And this is despite some assumed pressures from pricing or biosimilars, generics, or just overall pressures in the market. And implantables are the second largest segment with the highest growth projected over the next 5 years. So that does include the glaucoma implants as well as IOLs. But this is really, these are positive things to kind of anchor ourselves in. But we have to consider all the forces that are coming into play. So while all this is going on, we know that new technology releases tend to stimulate demand. This is especially true in the implant space with IOLs. We are seeing a lot of strategic partnership that can really change the space and create some growth. We're seeing some efficiency gains that may be possible through digital tools and integrations. of course, the disease population, and there's always this aspect of access to care and screening for patients. As that TAM is quite large, that doesn't mean we're necessarily able to address all those patients. So the further that we're able to dive into that patient segment, the more growth we might be able to see there. Having said all of that, on the negative side, there's a lot of payer power in our market. So that may be Medicare, that may be private insurance, that can be private payers, the patient pay, so your lack of consumer confidence comes to play. There's some regulatory uncertainty right now. We've got a little bit of back and forth. There is, of course, pharma pricing pressure and threats to care accessibility. But the good news is none of those are really new problems for ophthalmology. They may come in a different flavor, but they are still problems that we've already dealt with before and continue to deal with. So these aren't new to us. And with friction comes opportunity, as I mentioned. So we see a lot of this coming into play and working together. And I think that there are some opportunities here on the digital side and at these points of friction to actually create great multipliers in our space. There are abilities there for strategic partnerships to bring those new tools to clinic faster rather than doing organic development. Enhancing the screening so that we can bring more patients in and streamlining clinical evidence collection to reduce that administrative burden on the clinical side. But all this brings me to a point of this idea of unmet need, which is something that I think a lot of our investor colleagues always talk about, is we want to see large unmet need, and that's where innovation really comes in. And what I've heard a lot over the last 6 months is that unmet need doesn't necessarily need to be a disease state or a specific type of patient. This can be addressing clinical burdens, this can be addressing patient flow, this can be addressing administrative work that needs to be done so that they can actually treat the patients and improve disease states. It can be done on the manufacturing side in terms of how we are using digital twins to help maintain equipment and predict failures and get products to market faster. So there's a lot that can be done, and I think digital tools are the great multiplier, and that is a bit of my hype there. Hopefully the curve doesn't fail me. Thank you.
Thank you, Christine. Now we have Neha give us an overview of the capital markets.
Perfect. You know, we're in a unique time right now where it feels like the equity markets are acting a bit incongruent with the underlying market and macro environment factors. Rates remain elevated, though cuts have started. U.S. consumer sentiment, which Kristen touched on, is actually near an all-time low. And at the same time, every day you wake up and it feels like the S&P 500 has reached a new level of a high. What I think this means is that people are looking through what the near-term macro environment uncertainty is and saying, we'll reach normalization at some point, but that some point is kind of the question, right? And our macro economist thinks that the next year is really where you're going to see a bit of that correction come into fruition as some of the larger uncertainties become a little bit more clear. So as we look at unpacking, what is going on in the equity markets, healthcare, interestingly, has been under significant pressure. So policy changes, across reimbursement, volatility within the FDA has created a lot of uncertainty across all baskets of healthcare. But as you look at the one in the dotted box here, that's the ophthalmology bucket. Unfortunately, that is down 22% this year, and it's very much driven by the factors around reimbursement, the consumer sentiment point, and then a general view that maybe there is a bit of softness in the ophthalmology market across various disease states. So what works and what doesn't work with equity investors these days? I can really break this down into two buckets. There's the things that you can control as a company and the things that you can't control. So challenges within China, tariff uncertainty, FX headwinds, those are all things that companies cannot control. Investors are expecting a good amount of sobriety and conservatism as you talk about navigating those challenges. And then there's the things that you can control, giving clear guidance and pathways on growth and margin trajectories, delivering beats and raised models every quarter on quarter, and having innovation and new product introductions, either through M&A or through organic investment, be part of your regular dialogue with investors. And so it's it's a bit of a tale of two worlds, right? Investors want you to be very sober and conservative as you navigate an uncertain macro environment, but at the same time, they want you to keep pushing forward on the strategic agenda and be aggressive and not miss out on new and interesting market opportunities. So it is a very tough time to be a public company out there. And as we think about the IPO market and what it takes to be a public company, the IPO market has reopened. It's not the levels that you saw in 2020 and 2021, and frankly, I think that's okay. But it is selectively open, and interestingly, activity we've seen pick up post-Labor Day. Healthcare is muted, though. So, I don't see this returning to the levels of even 2018, 2019 in a snapback next year. But there has been activity across the device sector and more selective within biotech, but a lot of activity within the health tech sector, as I think people are finding this intersection between some of the digital tools and the services components breeding across other end markets. What works, though, is very different today. Investors are more sober and clinical. They want to know that stories are really been cold toweled, that they're clean, they're tight, there's no questions around, is there a reimbursement change that's going to happen? Is there something that's not totally dialed in on the clinical trial that's being run? And so the question that we hear from investors time and time again when we take companies out to go public is this a standalone company over the long term? Or is this something that should be acquired and held by a larger entity? And if it is a company that should be acquired, what is the right timeline for that? Because I think investors don't want something that should be a company that is at the time of the IPO really held by a strategic. They want something that can grow into being a strategic asset down the road, but there is a reason to deploy capital within it today. And so what does that mean? The other side of the coin is obviously what does that M&A exit look like? But M&A volumes remain low. And if you look at this is across all sectors, but if you look at it on a healthcare basis, it's even weaker. This is partially driven by a buyer and seller disconnect on value, but it's also increasing pressure that buyers are feeling to maintain EPS neutrality, that's earnings per share. So that makes it very difficult as you're thinking about innovative technologies, because inherently innovative technologies come with high growth, but they also come with a good amount of cash burn, and there will be EPS impact on that. It's not all bleak, though. Ophthalmology as a sector has seen a lot of activity. There's been folks like Essilor, Alcon, et cetera, who've done programmatic M&A throughout the year, despite the uncertainty in the macro environment. And at my firm, we are seeing a lot of pickup in activity as buyers are dusting off work on previous assets that they've looked at but maybe had shelved because of the uncertainty going on. As I think about the next year, what I think will drive up activity is buyers getting more creative on how do they bridge that gap on value? How do they use maybe more unique financial instruments, payouts, milestone payments, et cetera, and think about maybe looking internally to help manage that EPS dilution so they can get those deals done.
Thank you. I'd like to bring up Garrett, who's going to give us a picture of the VC environment.
Thank you. So building off what we've kind of covered, I want to dive in a bit deeper looking at the M&A and IPO trends, how those are impacting kind of the broader market, especially in venture capital, and this rise of these non-ophthalmology typical investors or strategics in the market, and how it's impacting how we think about that as VCs. And then drill down even further on the ophthalmology market specifically, and what investment targets are looking the most appealing for us at this moment. So as we've already touched on, liquidity events are heavily impacting kind of how we're looking at the IPO and M&A market, or the VC market. And so the federal funds interest rate, obviously has risen quite a lot since 2021, and that has obviously decreased the amount of IPOs that are happening in the market, and it has subtly impacted M&A opportunities. So this is the overarching, I think, driving force that's impacting kind of as we look at this as VCs, what we should be investing in, and what are the interesting areas. So that's something to keep in mind as we drill down a little bit further. So the IPO markets, as Neha said, they're starting to open up a little bit. We are seeing some interest in the biotech IPOs. There's been 5 with 1.1 billion raised, but those are starting to trend largely later stage. So you can see 60% are phase 2 and 30% are phase 3, which is a bit of a change from 2020 to 2021, where we saw a lot more of the preclinical and clinical or phase 1 type assets going public. MedTech also is a bright spot with 7 IPOs, and that was in later 2025. And those are obviously very late stage companies that are already in the market with on average revenue of 35 million. And so what we're seeing, the public markets are looking for large TAM products with later stage opportunities and potentially really secure revenue growth. On the M&A side, we are seeing some broad trends across VC-backed companies where M&A is trending a bit earlier. So we're seeing a lot of deals being done in the seed stage. And I think we've kind of seen that trickle down through on the life science side, especially in ophthalmology. So we're looking at ophthalmology specifically. There's been 69 billion in transactions the last 6 years. What's really interesting is these new entrants to the ophthalmology space. Think about the Mercks and the Amgens. They've done nearly 80% of the M&A deal value. And while it's being about half of the number of transactions completed, they do command a large amount of the market cap. So they're able to do a lot of these deals, and they are trending a bit earlier than the typical traditional ophthalmology strategics. Drilling down further on this, you can see the new entrants are really focused on pharma with about 86% of the deals, and they're looking at pre-commercial assets far more than their traditional eye care players. Now, how does this look for us as venture capitalists and what we're investing in? There's definitely a lot of demand for capital out there in the market, more demand for that capital than there is capital available, and that is starting to improve quite a little bit slowly, but I don't think fast enough for the amount of demand that's out there. We're also seeing that impact the median time between transactions getting out to 3 years, and a lot of the capital that is being raised by VC is being focused on AI and machine learning, with nearly 70% of that capital going to that bucket. And as you can see, that's impacting life science VC capital raise. That's been dropping quite a bit over the years. And so this has challenged us on what we're looking to invest in. It's challenging the early stage investment opportunities where that was really popular in 2021 when there's a lot of capital awash in the market. Now it's a bit tighter. Everyone's focusing on later stage assets. You can see how these trends have changed over time. And the rounds are getting larger and they're higher pre-money valuations. And then when you look at the data sets that show of the pre-money valuations, those rounds are typically in the $40 million range, if not higher. And that's broadly across all life science. So 90% of the deal value in 2025 were through 12 companies for ophthalmology. That was about 1.4 billion. So we're seeing a lot of focused investment on a couple of companies that are really exciting. That's attracting most of the VC investment. And then looking at the number of deals that have been done over the 6 years, we're starting to see larger and larger financing rounds being more and more common. So the anterior segment, a lot of blue space opportunities, as we talked about earlier, with myopia and presbyopia, and then also limbal stem cell deficiency. These are some bright spots where I think there's a lot of innovation needed, and so those are areas that VCs are looking at, I think, pretty interestingly, to say that this is something that could carry a lot of weight, could perform well in the market, and we'll be looking to invest there. On the retina side, obviously a lot of open opportunities. GA, we're seeing some really large rounds come together. Character Bio recently closed a large round. Aviceda early this year, raised a very large round. So we're seeing a lot of good opportunities for companies that are attracting a lot of dollars. I wanted to close it out by looking at what's been successful in the market. I think Gil touched on this early on about what companies are performing well in the market. And if you look at this, we're looking at the ECP concentration curve, which is the number of doctors you have to go reach out to on a commercial launch versus the commoditization of products in the market. So thinking about wet AMD, there's a few products and just a handful of retina specialists that you have to go market to. Those products do really well, and you have an efficient launch, which is why you look at Apellis and how well that's done in the market. We also look at Tarsus with Xdemvy. That's done really well, but they also had to go after a lot of eye care professionals to make that product work, which is really challenging. Once they proved it, the market really appreciated that, and you see about a 7.2 times market cap to revenue multiple. Where it's really challenging are the products where they're commoditized, like dry eye or IOP reduction. There's little differentiation, so it's really hard, and you have to really battle it out with the sales force. And typically your upsides are capped as you're competing for market share. So those types of assets are very challenging for VCs to invest into, since you're likely going to have to take it all the way and commercialize it to show success before you can get to an M&A transaction. So I'll finish it up with, these are the three areas we kind of really think about: products with large unmet needs, significant improvement to the standard of care, or high efficacy products in overlooked markets. If you're able to fit into one of those buckets, I think that's an opportunity for high interest for VCs, strategics, and public markets to value that and say that this is something that'd be worth investing money into early on. Thank you.
Great. Now we're going to transition into our panel discussion, and we're going to make this interactive with the audience. So we're going to alternate some polling questions with some questions to the panel. And we'd ask you to stop texting just for a minute. When the poll comes up, you'll get a QR code, and then that'll pull up a polling question and answer on your mobile devices so you can poll, and we'll wait a few minutes for it to kind of stabilize. We'll get some audience input and then maybe take what the audience thinks and compare it to what our panel is here. So maybe we can start with the first polling question. So this is really about, for you guys, how are you feeling about the environment? We just heard a lot from these great speakers. Pretty excited? Time for SSRIs, or how do you guys feel? And then let's see, it'll take a minute to tabulate, and we'll see. We've got 1,000 people voting here, so let's see if we can get to hopefully a couple hundred people voting. And then we'll go to our panel. And by the way, I love up here that we've got the next generation, really, of ophthalmology up here, that when I'm the only boomer on a panel, that's a good thing. So this is really, it's happening in all industries, but particularly in finance, where we're lucky enough to have three people with checkbooks here and a banker. And these are all the next generation people that are going to be funding the next generation of innovations. So this is great. Wow, you guys did a good job in your talks. People seem optimistic. No one's bullish though, so interesting. So let's go back to our discussion questions, and if we can get the next slide up. One more forward, so we can get our question. Great. So maybe we'll start with Roger and James. But how have you guys seen things changing? You talked a little bit about it in your talks, but and what areas are you right now investing in out there, Roger?
Yeah, I think the last year in the biotech world has been pretty tough, but I think in the last few months we're starting to see some signs of green shoots and recoveries here. I think it is a bit of a have and have-nots market, as I think some of the data kind of pointed out, where if you have initial clinical proof of concept, if you've got enough data that supports that this is going to be a big deal, then you can get the money to continue on and go into late phase and even commercial development. But for many early, especially preclinical stage companies, I do think it continues to be very tough, and a lot of that is just the amount of competition.
Yeah, and just to echo that, you have the post-COVID kind of boom and bust cycle, right? So you have a lot of companies that are still out there that have managed to survive, that have some data or even commercialization, that are then competing with all the new companies and the preclinical companies. So it's just become an incredibly competitive environment for those companies that are early stage, but very ripe for us as investors to kind of sort through. And then, did you want to touch on the segments?
Yeah.
Segments that are active. Honestly, I think, on the therapeutic side, every segment continues to be active. I wouldn't say that there's one particular area where we've seen a lot more activity than others.
Yeah, I think activity remains pretty steady across different areas. Gil talked about some existing markets as well as white spaces earlier. So some things that kind of excite us are, these percolating technologies, those white spaces that are finally kind of coming into their own. Automation, AI may make all humans obsolete, but from here till then, there will be a lot of opportunities to improve lives and treatments. And so, that might mean, where AI meets physical world, so like Horizon Surgical, surgical robotics, or automating the exam lane, the oculomics application. Those are areas that are really exciting us and are starting to get broader market interest. And then another way that I look at it is kind of the later stage, more generalist investors calling and asking for input. And one area that's very active in that segment is novel glaucoma therapeutics.
Great overview. Let's go to another few questions. I think Ramin has a few questions, but let's go back to question 2 for the panel.
Yeah, so we talked quite a bit about investors, and we heard from Christine about the market and so forth, right? So the question really is for Neha and Christine is, when you're looking at these assets, like what are the areas that investors and strategics are really looking to invest?
Yeah. I mean, I'd echo, it's not really a particular end market. It's really about where does the technology play within the existing space. So if it's something where there is a lot of technology in existence, why is that the solution that people need to own, right? And I think for, on the question of is there only really one strategic out there, there's a lot of pools of capital. There's private equity, which owns a few assets. It's looking to continue to consolidate across the space. You're seeing folks from, adjacent areas within ophthalmology thinking about how do I broaden into diagnostics, surgical, et cetera, and bringing in services platforms. So I do think there is a lot of new activity. If we looked at the market maybe 3 to 5 years ago, you could say there's only one real acquirer out there. Now it feels like there's a bunch of different pools of folks who are trying to build their own ophthalmology ecosystem. And so it's just about finding what is the right fit within those organizations.
Yeah, and I want to echo on something that you said earlier about just like the disciplined investment. And so I see a lot, well, first off, we are seeing other strategics play in this. Topcon has had some acquisitions. Zeiss had one recently on the vision care side. So there are definitely other strategics out there investing, but we are seeing some more, what I would say, creative partnerships or just pairings. And so you see like a one product peel off where you see a company, when it comes to digital especially, so a standalone software that doesn't have an attachment to a diagnostic or a surgical approach or a therapy, that has a really uphill battle to play. But when you start pairing it with a diagnostic, when you start pairing it with a therapy, now we're starting to increase the efficacy and the efficiency of all 3 of those items. And so I think that we're going to see strategics start to kind of pull those in a little bit more as well.
I can tell you, like, what I was really excited about last year, compared to last year, is last year was all about the back of the eye. And what I heard today was that we're looking at actually all the eye, right, front and the back. And then when you look at the number of strategics, as you kind of pointed out, there's new strategics like Astellas or Merck who are just emerging. So that's really exciting to see new people also coming into the marketplace.
Very true, very true. Well, let's go to the next panel question here.
So, when you think about it, we talked quite a bit about uncertainty in the marketplace today, right? We talked about, obviously, the presentation you made about, from a capital perspective, some of the government issues that we have, and things could change, right? Something could come out this morning, could change the entire market by this afternoon. Let's take a question about, in terms of this for Garrett and Neha, what are the key challenges that are stalling deals compared to prior years?
It's things that you have listed on here, right? It's tariff. I even say regional exposure. Having a lot of exposure to China does give, for a public company acquirer, a pause because their investors are saying that market is uncertain right now. And now it's a big patient population, so people do need to figure out over the long term, how do I play within that market? But announcing an acquisition with a lot of exposure to that is, something that's a bit challenging. So I think, for the strategics, particularly the public ones, they're trying to figure out how do I balance what I need to do internally, meaning talking about tariffs with my investors and my mitigation strategy, figuring out what reimbursement changes mean for my existing set of products. How do I navigate the FDA when, I have a bunch in the pipeline already, and what does that mean for my outlook with, okay, I've looked at a bunch of deals, and I know this is very much on the strategic roadmap. The timing seems to be now or never. I have to kind of weather the storm and continue to be active. Now, it's just hard, right? The bar is higher. So I do think that a lot of the uncertainty is going to make people be a little bit hesitant to go after a bunch of deals. So I just think that it has to be of the highest strategic level for people to pull the trigger right now.
Yeah, I would agree with that. It's all a matter of compounding risk when you really think about this. We are taking a lot of clinical risk with these companies, management risk. When you start tying in regulatory risk or reimbursement risk, it's really challenging to invest in that. So, on the device side, we really push a lot of these companies to look at, do they have existing reimbursement codes they can use? If not, that's going to be really challenging on top of the clinical risk. On the regulatory side for pharma startups, this is also something we really take a lot of look at is, if you're looking at the wide space, usually the regulatory pathway is not cut and clear and you're kind of blazing your own way. And that is a big challenge and a big risk, but that is where we need to go. And so, we have to work closely with our partners at the FDA and our regulatory consultants to make sure we understand those risks and work with them and lay out those pathways so we can get these new therapies to patients, since that is the ultimate goal. But that's definitely, in the current atmosphere, those are challenges. There are things changing that we cannot necessarily predict right now, but I think over the long haul, things will stabilize and we'll be able to kind of push forward and drive these innovations to the patients.
That's great. All right, let's go to the audience now and go to our next polling question, if we could pull that up. And this is kind of about what you guys think is going to be important if you're going to be pitching an innovation to a venture capitalist or to a business development group. What's the most important thing to be stressing in your presentation? I see some startup CEOs out there smiling. They've been out there. They've had some experience with this. So let's see what the audience says. So people are leaning towards IP. Let's see. Let's let this load a little bit more. Because this is always, I think there's a lot of misunderstandings about it. It'll be interesting what our investors are going to say here about what people really are looking for in a pitch. So people are really talking about, they want to see the novel technology with some good patent coverage. And I can't see, can we see at the bottom on my screen? I can't see the team at the bottom. I can't see what that number is. There we go. Wow. Pretty low, and can we see the strategic partner in place? That must be very low also. Wow, we don't put much value on the strategic partners. Okay, well, we see what the audience thinks. Let's go forward to the panel. So I think this is very interesting. So let's go back. I think we need to go back one question here.
Well, it seems like...
There we go.
There we go.
So for you guys, for our investors with checkbooks up there, so you're hearing a pitch. What would you say? What are you guys looking for? Is it that patent that just seems like there's no one can get around it, or what are you guys looking for?
So we think about this a lot, and our kind of pat answer is it's the people that drive the product forward. And when we get involved, we're not involved for a year or two. It's typically 5 to 10 years. So we want to know that we can work with these people across all challenges. But the novel technology is important, because if you don't have that novel technology, you're probably not going to make it through that first stage. Although if you have an experienced founder and executive that has several exits and they call up with something that doesn't necessarily appear novel, you'll take the call. So I think those two go hand in hand, but they're all important.
I would definitely echo that. The strategic partnership is kind of interesting to see that low, and it kind of goes back to what I was talking about earlier. We're seeing some strategics willing to acquire very early on these really novel new technologies. And I think that's a driver because there's a lack of investment in those kind of preclinical phase 1 stage companies. So for a VC to take that risk in those early stage companies, I think having a partnership early on is important because it takes a little bit of that risk off the table. But kind of all of that said, you have to have the technology, you have to have the IP, you have to have a really strong team you can work with, because things will change and you can never really be sure what the future will hold. So you want to be sure you can navigate that as best as you possibly can.
Yeah, for me, I like to start from the end and really what is going to be a big deal for patients, providers, whether it's first in class or best in class, clearly best in class. And then you work backwards from there to figure out, okay, what are the steps to be able to de-risk, to be able to increase the probability of success that you do have such a big product in your hand. And really for each step that a new investor is going to come in, at the end of the day, it's very simple, right? We need to expect that based on the de-risking that you're going to achieve with this current amount of capital, that the value of this company, this product is going to be worth more than it is today. And if that's not the case, or if there's a lot of risk to that, then why would I put my money in now, not knowing that I'm going to get more money at the back of this round?
I would also kind of to echo that as well. When you think about investing, we hear sometimes, oh, well, we'll sell it post phase 2, or we'll sell post phase 1. There are no guarantees. You have to be really willing and ready to run the whole way and commercialize it on your own. And I think when we're thinking about investing in something really early on, if it doesn't really have the legs to support a commercial infrastructure really far down the road, that's probably going to be a hard one to jump into unless you have that strategic partnership early on where maybe that's where it's going to fit. But looking broadly, it has to be a standalone commercializable company, and you have to be willing, you have to have the team and the mindset and the resources to be able to pull it off. And I think that's why you're seeing these kind of mega deals coming together with a lot of the large VCs syndicating together and financing through multiple stages to make sure that these companies can get all the way through approval and potentially be ready for commercialization.
Great. Let's go to our question 5, if we can pull up that slide. Great.
Well, it seems like you answered a question, but if I think about a poll audience, strategics don't value that much, so there goes my self-worth. But when you think about partnership, and this is for all the entire panel here, right? How important is a big pharma strategic collaboration with a startup, or can ventures just still go alone?
So I will say, I mean, you're asking a bunch of math people up here about how to do these things. So obviously it's a very exciting group at a party, but at least you guys have a checkbook. That makes you a little bit more fun at a party than me. So I think Garrett made a great point earlier. This is all about compounding risk. And so if you don't have the strategic partnerships, then by gosh, you better have an excellent team, you better have really strong IP, you better have a great, huge unmet need market that's not being addressed, or a product that is going to be clearly best in class, to your point. But if you don't have all of those things, if you're not knocking it out of the park on all of those, then yeah, I mean, I think strategic partnerships definitely increase the value of whatever you're doing. And in a world today where, especially for pharmaceuticals, a global market is really important, it is really expensive to do that on a global scale. So having at least some geographic partnerships so that you can get access to those other markets easier, quicker, faster, all of that is really beneficial.
Yeah, to build on what you touched on, Garrett, I mean, one of the things that I like about ophthalmology is the fact that smaller companies have been able to bring things to commercial and capture most, if not all, of the value for themselves, right? Because I can spend my money investing in a new weight loss drug, for example. But that's a market where my startups are never going to compete with Lilly and Novo marketing these products. And so honestly, the thesis has to be that a strategic is going to be interested in the space. Of course, it's a much larger space than what we typically deal with in ophthalmology. But the idea that you can capture value credibly with amounts of capital that you can actually raise from investors like us or even other sources is one of the most attractive things about ophthalmology, in my opinion.
Great. Well, we're running a little low on time. Let's go to the last polling question, which is really about what the audience is excited about. So we gave you 4 categories here to look at: IOLs, glaucoma drug delivery, retina, and Oculomics AI. And let's see what our studio audience is interested in here. And wow, okay, we've been selling Oculomics, and it disappeared. All right, let's wait for this to stabilize here. And yeah, this is a little more predictable here. So we're coming up big on retinal therapeutics, but let's make sure we get enough votes in here. I think maybe just Dave Geyer and Praveen Dougal are voting here. Let's see what happens here. Yeah. Wow, this is great though. So our white space areas are coming up pretty high. So thank you for your interest in that. That's great. And seems like IOLs are maybe the poor cousin here. Interesting. Okay, so definitely people like the big market that's already an established market with new products coming into it, but they also like the white spaces. So let's go back to our panel, and maybe you guys could quickly give your ideas of what you guys are excited about, particularly the checkbook gentleman down here.
Yeah, talking about self-worth, I think we're only here because of our checkbook, but that's okay. Yeah, I mean, retina is obviously, it's the monster in the room, so it's obviously attractive. We just invested in Revopsis. We're excited about that. But, what's exciting me most about the space right now that I'm most excited about, and I see the white space, we're investors, we're VCs, we like shiny things. So that's the oculomics, the AI, and robotics. So that's what I'm most excited about, and I think it's starting to finally percolate and come into its own.
Yeah, for me in the drug world, I would say it's the white space, and for us that means opportunities where we just haven't had any solutions for patients to date. And I think there's a lot of spaces where we're on the cusp of getting some really, really exciting clinical data that's going to at least give us a good sense of whether new approaches and new solutions for patients are possible. So that's what I'm really focused on these days.
I'd agree. It's white space. In particular, I think some of the corneal diseases, we saw the Orion deal with Halcon, which is interesting. Oxybate and NK is also done really well, creating $1 billion market there with one product. I think limbal stem cell deficiency is another one that's going to be akin to that. And then glaucoma, we have a lot of treatments for IOP, but no one's really cracked the nut on neuroprotection. That is really exciting. And then GA we've seen is a very large category, but moving upstream to intermediate AMD is a very large opportunity. So I think there's a lot of white space, blue ocean, whatever you want to call it, and we need to start looking at those areas and not just the incremental improvement to some of the stuff that we treat well.
That's great. Well, listen, we're a little low on time, so I think we're going to try to wrap up here. But as a bonus extended play here for our audience here, we want to do something with the panel that's going to be a little fun. This has been serious. We've really dug deep. So let's go to signature Eyecelerator. I think if we could have the next slide, please. That we want to play Name That Stock. So what we're going to do is show our panelists who have not seen any of these stock charts. We're going to show them, if we can get through at 6 very quickly, stocks, and see if they can figure out what they are, and there might be some salient points in this. So just to get people calibrated, this is what it's going to look like. Everyone know what this is? It's the S&P 500. So we're going to show you a chart. You can kind of see this has that. This is year to date. It has a little jag in it from the Independence Day tariff in April, but generally going up, and we've got 13% return on the S&P. So as we think about investing in stocks, we want to see stocks that are certainly returning more than 13%. Otherwise, you could buy this ETF, and why should you be investing in some exciting stock? So let's go to our mystery stocks, and this is mystery stock number 1. So you can take a look at this. This is looks like it's been going up. It's in green, which is good. It's about $40. Almost a 40% return. Any ideas what we have here?
Lens.
Anyone else? Harrow? Any other? What's that?
Apellis.
Apellis. All right, well, let's see. And the answer is Lens. All right, ding, ding, ding. Excellent. And why is this going up so much? I mean, this has gone up a lot.
Oh man, I think it's an exciting market, presbyopia. They recently got their approval. They're brought to market recently their samples, which I think got a lot of interest uptick. It's a very large market. I think you touched on it earlier. It did take a bit of a drop. I've heard different things around AEs for it, so maybe that's why it kind of came back down from that recent uptick at samples and now back down a little bit. So we'll see how that plays out. But I think it's good for the presbyopia market. There's a lot of interest, and it's a $1 billion plus market cap.
Every public investor just is waiting on their viz samples, and to see whether they want to buy this or not.
All right. Excellent. All right, I love it. Let's go to the next one. Let's go to mystery stock 2. Wow, $73. Pretty good performance, 33% almost. Wow, this thing's really been rocketing lately. Any ideas here? Give you a hint, anterior segment, white space market.
Tarsus?
Tarsus, yes, Tarsus. All right. Been really a lot of appreciation. Does anyone know why? I haven't seen any announcements. Anyone know?
I mean, I think the thing about it goes back to market creation. There's an unmet need which the company addressed. I think if you think about it from an execution standpoint, great execution, right? In terms of creating a market, really being systematic about Salesforce, but also DTCs helped quite a bit. And then reimbursement, right? Those were the 3 areas that I think is really driving that stock.
Yeah, and they recently had a $100 million quarter of revenue, which is very impressive. And as I said in my presentation, they're trading at 7 times revenue, which is, I think, fantastic. And they've done a really good job with the execution of the commercial launch. And I think now, as we kind of talked about some of these new entrants, I think this could be a budding new strategic as they maybe look to doing some M&A with this war chest they're building.
All right, fantastic. Let's go. We're almost out of time. We're going to fast forward. Let's go to number 4. And anyone tell us here? Okay, looks like, again, pretty good performance, $11 stock. Again, pretty good return. Ocular Therapeutics, and they just, interesting here, just to mention, stock went down a little bit. They raised a huge round, $475 million secondary, very well funded for going forward. And let's wrap up with this last one. Anyone know what this one is here?
EyePoint.
EyePoint, excellent. EyePoint Pharmaceuticals, kind of a competitive company, Ocular and EyePoint. EyePoint, just to notice here, they just raised $150 million in a secondary offering. Both these companies are kind of getting a war chest up of being very well funded. The stock went down, as often happens when there's a secondary. Why? Because there's more dilution. People don't like that. But this is very encouraging. Both these companies are able to raise a lot of money to do the very expensive clinical trials that they need to do. Well, I want to thank our panel here for an amazing time here. It's time to move on. Thank you, guys. And